All right. Thank you for tuning into the Equity Channel, where we provide the highest quality stock market analysis to individual investors. Our goal is to help you improve your returns while keeping you up to date with everything you need to know. What helps investors beat the market is information and knowledge of how to use it, and we'll provide you with both. Before we get started, be sure that you subscribe and turn on your notifications because every time we drop a new episode, money is made. Right. It's gonna be a good day. Give everybody a chance to get in. What's going on? What's going on? Folks? Yeah, we're a little bit later than we thought it was gonna be. Just a little bit later. Hey, Genia, can y'all hear any music at all? What's up, Shay? How loud is it? Is it too loud? Is the music too loud? All right, good, good, good. It should be like it should be almost. I want it to be almost too low for y'all to hear. Say she can't hear no music at all. Yeah, good. Yeah, that's how I wanted it. I'm testing out the volumes. I'm testing out the different volumes. I just put it on pause now. But I'm testing out the different volumes right now just to kind of see, you know. Mm-hmm. Just giving everybody a chance to get on up in there. But yeah, I'm testing out these different elements here. Uh, so like right now, sorry about that. So like right now, it should have been stopped playing, but it's actually still playing. So I'm waiting to see how long it takes to go on pause and stuff like that. You know what I mean? Yeah, that's crazy. Hold on, let me see something real quick. Why is this thing still playing? Let's see something here. Huh. That's pretty interesting. I guess we'll dig deeper into that another day. But usually, if I hit pause, usually if I say pause, it'll stop playing the music. Um, so that's pretty interesting. Pretty interesting. All right, let's get into it though, y'all. Let's get into it. Let's get into it. Let's get into it. Um, so we're gonna start off by talking about what's likely to drive the markets. Right, what's likely to drive the markets next week? Um, we're gonna have a few things popping up on the economic calendar. Right. I have a few things popping up on the economic calendar, but the biggest thing next week is going to be the jumping off of the biggest thing next week is going to be the jumping off of earnings season. Earnings season is going to jump off a little later in the week than we expect. We're going to take a look at some of what's coming up next week on the earnings calendar as well, just in case you want to get ahead of something. We're going to look at this week's earnings and next week's earnings, right? Just in case you want to get ahead of it, right? Just in case you want to get ahead of it. So we'll look at stocks to watch in that regard, right? As well. All right. Now let's see here. So as you can see, nothing really big, right? We got FOMC minutes. I am most certainly going to be looking forward to that. Right? FOMC minutes. I wanna see everything that was talked about in that last meeting. Core inflation on Thursday. That's going to be a big one. And then by Friday, you're gonna be looking at your PPI report, all right, and consumer sentiment. So for the most part, Thursday is going to be your big shocker. All right, Thursday is going to be your big shocker there. Um, you wanna really um you wanna really give yourself like make sure that you're not doing too much ahead of Thursday. If you got some if you're too directional to the upside by Wednesday, I would recommend picking up some long volatilities just to offset some of that potential downside if inflation comes in hotter than expected. All right. And I say if it comes in hotter than expected because, well, we don't know exactly when we're going to start to see this tariffs action feed into inflation. We don't know exactly when we're going to start seeing it, right? So, you'll want to be a little you want to be a little careful there with that, right? Now, let's see here. Then we have the earnings for next week. All right. Monday is going to be very light. You got Dave and Buster's and Levi. All right, Dave and Buster's and Levi. Um, nothing else that I'd really pay any close attention to there. But Levi might have themselves Levi might have themselves one, man. You never know. What's going on, Kenneth? Remember yesterday I said I want to check out Air Test Systems. Just so happens that they're going to be announcing earnings on just so happens they're gonna be announcing earnings on Tuesday, and they were up 5.5% on 5.5% on Friday. I thought that was so interesting when I saw that. I was like, here they are making it make sense that I wanna dig into them a little bit and see what's going on there. WD-40 will be reporting on Tuesday as well. For those that actually still care, so will Tilray. So will Tilray. I swear I gotta wonder, is the marijuana industry ever going to find their day? Is that day coming at any point in time? You know, I'm just wondering, man. Just wondering, is that day ever really coming? What's up, Kenneth? What's going on, AC? What's going on, guys? Walgreens, dear Lord, these guys here. Um, it just seems to get worse and worse for them. Calm, the largest egg producer, will be reporting on Tuesday as well. You gotta wonder, are these guys getting any kind of, are they getting any kind of benefit at all from these egg prices? That's just a question, you know, that I might have in mind. Yeah, hey, maybe someday it's coming. Maybe someday it's coming, Shay. But I mean, Lord, they've been raked through the coals. I had a guy, right? I had a guy the other day. I was having a conversation in one of those other spaces, right? I'm sorry. Give me 1 second, guys. All right. So yeah, so I was talking to a guy the other day, right? And you know, uh, as I'm talking to him, he's saying, yeah, he basically he can't I can't deal with stocks, man. Stocks ain't for me, and stocks are no good. I'm like, what do you mean stocks are no good? What does that like what does that mean? He's like, they don't move fast enough for me, you know. So I'm like, okay, um, if you say so, He's like, yeah, I invested in a bunch of I invested in a bunch of marijuana stocks back in the day, and it didn't work out. And I'm like, was that like the only thing you invested in? He's like, he invested in marijuana stocks. I can't remember what else he said, but like, marijuana was like the bulk of his investment. And I'm like, well, of course you feel like stocks are no good if that was like your biggest investment. I said to him, I said, it seems to me like you you made a bet that um that marijuana was gonna be legalized everywhere and become the next big thing, and you were wrong about that, and you're blaming the stock market instead of saying, you know what, I should have better ideas, or maybe not better ideas, but at least um, just do something differently, Um, so yeah, some people just need to really you know um, rethink how they look at the stock market, so that way they can better benefit from it. You know. Now this is what we're looking like on Wednesday. Looking like on Wednesday. One second here. So Delta Airlines, Constellation. That's pretty much it. I mean, Price Smart. If you does anybody even look at Price Smart anymore? I mean, like as an actual store, not a stock. But um, does anybody actually go to Price Smart? Anyone? 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 Going on, Christopher. On Thursday you're gonna have CarMax, but the official earnings season, the official first quarter 2025 earnings season will kick off. Hold on one second. All right. So official earnings season will kick off around Friday. All right. The official earnings season will, will kick off about Friday. Uh, this is where your banks are going to start to, banks started off, right? So J.P. Morgan, Wells Fargo, Morgan Stanley, BlackRock, Bank of New York, all coming in on all coming in on Friday. Look at Children's Place. Oh my Lord. $7.20 per share. Wowzers. I gotta click on this really quickly here. Um, Wowzers. Yeah, that's right. I don't know if you guys remember, we took a look at Children's Place um back in like 2022, right? And we said we're staying away from Children's Place. Um, that is crazy how much they're down since then, right? And the sentiment is still more bullish than bearish. uh, you know, uh, That's absolutely crazy. By the way, um, StockTwits, in my opinion, has the best earnings calendar of all earnings calendars. I know people like Earnings Whisper, and some of those other platforms. But let me tell y'all, watch this, watch this, watch this. See, and the reason why, the reason why I like them is because they're not as complicated, right? Like, if I was to go to Earnings Whisper, right? If I was to go to Earnings Whisper, let's pull these guys up here, right? Um, you'll notice, like when I get over here, right? Look at this. Jesus Christ, how many times am I gonna hit accept? Like, dear God, Earnings Whisper is. Look at this. This is terrible. This is terrible. All right. I think people like Earnings Whisper because they seem to have some sort of you know uh so yeah, they seem to have sort of like a, this they're almost like pitching an edge, like you can have an edge on the market kind of deal, you know. Look at their calendar, so go over here and, you know um you might have the whisper number, you know if they have them there, right? And so you're just dealing with so much here, um can I turn on the list view? Okay, let's go to list view. Revenue estimate, earnings estimate, revenue growth, blah blah blah. It's just something that's just not, like, something that's just not as, I like the fact that when you go over here, right, look at how neat it is. It's just neat. It's just neat. It's straight to the point. It sorts it out by pretty much order of popularity. So you want to know what my favorite earnings calendar is? My favorite earnings calendar is StockTwits. Earnings Whisperer, I commend them for everything they're trying to do. But yeah, it's just a lot. You know what I mean? It's just a lot. And on top of that, I just think this, they need to do a lot more with designing that website better. I think StockTwits was clearly designed for, you know, to be lighter and have less of a old and outdated feel, plain and simple. Now, all the other parts of StockTwits, I would recommend, stay away for the most part if you can't, you can't help yourself from taking other people's ideas and stuff like that, because you're gonna get a lot of, so StockTwits is, like Twitter for stocks basically. So you're gonna have a lot of people saying, oh, I like this stock, I like that stock, and, you know but I'm talking about the earnings calendar itself. you know Beautiful design in my opinion. Now, next week, Monday, we're going to continue on with the new earnings season. Goldman Sachs, Applied Digital, M&T Bank, right? On Tuesday, PNC, Bank of America, Johnson and Johnson, United Airlines, Citigroup, right? You're going to see those there. Interactive Broker, JB Hunt. All right. And then we're going to start to see a little bit of tech leaking by Wednesday. ASML will report. You'll have Abbott Laboratories, Kinder Morgan, Las Vegas Sands, CSX. All right. Citizens Financial is going to be coming in to continue on with the financials reporting. All right. First Industrial Realty. That should give us some idea of what's actually going on with the with the market for industrial spaces. You know, data centers. You know, how do they plan on dealing with the energy transition over there? All that kind of stuff. You know. Uh, Thursday, Thursday. You're gonna have Netflix, Taiwan Semiconductor, United Health, American Express. You can see it's gonna start to get a lot thicker by Thursday. So you see, 55 people reporting. Then as you get, as you now if you go into, you know, the week of April 21st, that's when you're gonna start to see those big days are gonna start coming in. They literally have DJT. Look at how many people are following DJT. You gotta stay away from all right, all right, all right. Okay, Aaron, I see you. I see you. Taking cue from the chat. I like it. I like it. All right, I'll definitely take a look at those. I'm writing them down right now. All right. I have a request list right here. All right. IFRA and Catapult. All right. Excellent thing. Appreciate you for sending in your request. All right. So that's what's going on. From an earnings perspective, right? Over the next couple of weeks. So you really start to get your pickup here in a couple of weeks, and that's when we'll start to see the bulk of what we may see as the impact from any early impacts from the tariffs, because it's still pretty early, right? Still pretty early. Now, other than that, let's slide back over here. Um, you know, we again, FOMC minutes on Wednesday. I'm going to repeat for those that weren't here earlier. If you find yourself being heavy long by Wednesday, either take some long volatility, or if you have profit on the long side, take some of that profit, please. You have inflation reporting on Thursday, and there's no telling if the first impact of those tariffs is going to be kicking in by then. There's no telling if the first impact of those tariffs is not going to be kicking in by then. All right, so be sure that you get that done. Now, next thing we want to do, let's take a look at our technical levels. Let's take a look at our technical levels, and let's analyze starting with last week's volume. All right. This is Monday right here. So what I'm gonna do, I packed all of my stuff up in this nice folder here, so I can just boom, right, get everything out of there. All right. But I do want to remind you guys. So very similar to how let's go to the weekly chart actually. All right. Very similar to how we would put our key levels on our chart every week. The same goes for when you are. The same goes for when you are utilizing the new system that I taught you guys with adding your anchored volume profile, setting your Fibonacci to the anchored volume high and low. The same thing applies here. The same thing applies. The same thing applies that we would do anywhere else. You want to make sure you're making those adjustments each week if you need to. So right here, you can see our value area low, our value area high came down, right? So our value area actually shrunk a bit. Okay. So we needed to just adjust that Fibonacci to make sure that it was right at the value area high. So that way we're looking at the right levels. So if you look at this, if I was to put that back, right? You see this level right here? It's at 501.42, right? Before last week, yeah, it was closer to like 503-ish. Okay. So that's the first thing I want to do is make my adjustments there and make sure that make sure that's locked in. All right. Let's go back to the daily. Next thing we need to do here, let's go ahead and analyze what happened last week. Let's talk about what happened last week. Ready? Boom. So this right here is a classic, uh, you know, continuation setup here, right? Now, I will point out that we are pretty far off of our value area here, right? Even if I was to swap it out for the 70%, right? Same thing, okay? So we're pretty far off our value area here. You can see how this is so this is definitely a sign that we could see at least some new lows next week. All right. The question would be, do we close at a new low on Monday? That's going to be the big question. Do we close at a new low on Monday? We can make a new low on Monday, but do we close at a new low on Monday? That's going to be the big question. There is with this volume setup here. Let me explain it to you guys so that way it's very clear. Whenever you see the volume setup like this, so you have these 2 points that are both suggesting reasonable amount of activity happened in these areas. That's a sign of a continuation, right? Otherwise, you would see it sort of just drop off down to here, in which case you start to see some bounces. And you saw that yesterday when we were watching the market. The thinner the volume was up top, you got those retracements, right? Or the slimmer it was at the bottom, you got those retracements until the market finally started putting some volume in one of those areas. Then that ended up being to the downside, right? And then you close outside of the value area to the downside. So that's at least a sign that we could see or should see some new lows on next week. All right. Again, the big question would be, are we going to close at lows? Are we going to close at those new lows? Now, we did have our worst case scenario. We did have our worst case scenario level for the spot for the S&P 500 at about 4,646 or something like that. I can't remember the exact number, but I mean, wow! Imagine if we hit the worst case scenario. I mean, this quickly, that would be crazy, right? Like, it's one thing to say, "Hey, I understand this is what the market's worth," right? That's one thing. You know, you can't ever tell when though. Can't ever tell when. So you have to just be diligent in staying focused and you know staying consistent. That's what you got to do. So we're looking at these levels, but we're not saying, oh, this is going to happen next week, right? Myself and a friend was just having the same conversation, which is like, people are very disingenuous in that matter. So, hey, look. You can say you thought you think a drop is coming. You can't really tell us when, and we just got to admit that, right? Now, in the moments like this, these are called feedback loops. So you get an idea of, okay, cool, some new lows next week, but you know, uh, how do we close out each of these days, starting with Monday, right? You would want to see a new low, maybe set on Monday, followed by a bounce from there, and you know, that actually starts to give more of the vibe that you probably want to see here. Because if you're not gonna get any buyers stepping in next week, then that's a call sign that these guys are definitely trying to stay out the way right now. Right? And that's a really, really tough situation for a market that's already in free fall. Okay. Like I said, the Fed's not going to step in just for the stocks alone, and the Fed actually told you that on was that yesterday? I think the Fed spoke yesterday. I think it was yesterday, right? The Fed told you that, like, hey, we're sticking to our guns. Our job is inflation and and employment, and that's what we're going to focus on. So, like I said, they're going to have to really, you know, uh, give some sort of a. They're going to have to really give some sort of a reason economically that the Fed should cut these rates. So that becomes the big issue right there. All right. Let's talk about the key levels though. All right. If we focus on last week, from a so I'm gonna go from a Fibonacci perspective. All right. Let's go ahead and reverse this around. Alrighty. Let's go to the look right there. Let's go look. All right. So if we were looking at the value area from last week, um, and taking that into consideration, you can definitely see how this 549 area is gonna, if we, make a push, it's gonna definitely become 549 to 556. Actually, this entire area right here, I'll box it out. This entire area right here is gonna become a potential issue in the market as we try to get back above that area. So we'll keep our eyes peeled there. Right? But to the downside, let's take a look here. The downside, your next key levels are around let's take a look at this. So 497, and then back to the upside there. If we're focused on these key levels to the downside here. So let's put that on mute for now. We'll come back to that. Go over here. Let's open up our pro pivot indicator. What's going on from a standard deviation perspective? Second here. I need to make sure I got enough. Yeah. Alrighty. So as you can see, we're already trading outside of that 3 standard deviation band right there, right? If we were to go beyond this point, if we were to go beyond this point, then you're pretty much right. So you got 511 minus Let's see here. Right. So that's interesting. It puts us at about 487. Let's go back over here real quick. I actually want to see this again. So okay, so that puts us like so just outside of the golden zone here, pretty much, right? Um, so that would be our next deviation band, which would be absolutely crazy, by the way. But hey, we're not here to tell the market what to do. We're here to you know make our projections and carry on from there, right? That's what we're here to do. So the 511.99, by the way, kind of stuck around a little bit from last week there. So basically, let's see what else we got going on here. Mm, mm. You see 484 right here again, right? Let's go back over here. See 484 right here. Now remember, these are two totally different methods. This is Fibonacci's based on the anchored volume high and low, right? These are pivot points. These are pivot points. All right. So so 484 is clearly going to be a key level. Okay. Um, let's see if we see it anywhere else here. So for now I'm looking at 484 as a level with two points, 2 points on it of confluence here, right? All right, cool. Let's see what else we got going on here. So let's just put two markers on that. All right. Let's see what else we got happening here. So 535 as a point of resistance. 535 as a point of resistance. Hmm. Now I got the 14-day average right here at 558. I got one standard deviation at about 559. So they're both about around 559, right? So another key level I'd put out there is 559. All right, that's gonna be another key level next week. We're gonna pay attention to. Let's go over here really quickly and see if we got anything in that area here. We got 549 and 556 right here. So we're in the area, but so this would be as we approach this area, if we approach this area next week, right? If we do, and it's crazy to have your 14-day average this. It's crazy to be this far below your 14-day average, right? Um, 4 times the average true range, right? That's 4 times the average true range. I repeat, okay? Let that soak in, right? Let's see here. 446. Now these are targets here, so we don't really use these as support and resistance levels, right? These are just targets. All right. Now don't get me wrong. Don't get me wrong. Um, they most certainly can act as support and resistance. Let's see which ones we got here. So C9 plus. Okay, like these ones, the medium term ones can most certainly act as support and resistance. The shorter term ones, you know, these are more so just targets, right? So we most certainly can take the longer term ones here. But the shorter again, the shorter term ones they can still work though, you know. But I will say this one right here is sitting around that 484 ish, you know, 488, 489 here. So, but you know, I'd focus on the medium term ones here. So yet again, we have you know, we got 552 ish. So not really, you know, not really a lot going on in that area. All right, we got 535 here. And but we got to go through so what I like to look at where you close at 505.28, right? And look at the levels we have to go through if we got to get to the downside or the upside. All right. So if we have to go higher, 520 comes first. All right. So you can see here this matches up here, right? Um as a, you know, as a key level there. Um but yeah, but other than that, you know, so 520, we'll call it 521. All right. So let's go over here real quick. Let me show you guys what I'm doing here, right? Oh, look at that. Look at 521 right there. Right at the value area high, right? That's pretty crazy. Right at the value area high. So let's go ahead and go ahead and get those out of the way real quick. We're gonna leave this here. All right. Let's start laying this out. So 484 484. Okay. 521-ish. Right around here. 559. 559. Okay. All right. So let me just lock these in here. So these are going to be our weeklies here, right? So y'all can kind of lock those in, right? So 484, 521, 559. All right. So these are going to be the first areas that I'm really going to focus on for next week. Let's drop these if we pop those retracements back on there, you can see how those retracements are lining up with some of those levels as well. You got about 556. So right, and it's crazy how that 559 just like smack in the middle of this area that we were talking about, right? So if we do make a move higher next week, and it's a big move higher, you know, if we get out of this area here, it's gonna be real. It's gonna be real difficult gonna be real difficult to um it's gonna be real difficult to get, through this area right here. Real difficult, right? So I want y'all to keep that in mind as we go into next week. If we approach this area at all, if we approach this area at all, let's just be mindful that that's going to probably be the toughest, to break through here. But you can see all your support levels right now. So, let me go ahead and stretch this out here. If you want to take a snapshot or something like that, just kind of snapshot all your key levels for next week. Let me go ahead and let's all right. There you go. In case you want to get a snapshot for next week, go ahead and do so now. Give you a second. Put your snapshot on. All right. So those are going to be our key levels for next week. Now, one thing I want to do here. All right, let's get back to where we were. All right. One thing I want to do here is let's go on over the bar chart. And again, shout out the bar chart yet again. As you can see, they uh they got your boy back right. You got your boy back right. Taking care of the teachers. Taking care of the teachers. Shout out the bar chart. All right, now let's go over here to our. Where we at? Where we at? Where we at? What am I looking? Oh, okay. This is the E-minis. Let's go to SPY. Okay. Go to SPY. And we're very close to that level we talked about here, right? Where we said by that point you won't have any gains since 2024, since 2021. I meant to say, right? Um, the entire market would have been, uh, would have been cashed out. Anything above 2021. 1 second, guys. All right. Now, implied volatility is above historical levels. Ivy rank 100%. Ivy percentile 100%. So in this particular case, this is the highest Ivy has been, uh, over the past year, pretty much, and it's at the top end of the range. That's basically all that means. All right. Now, now, let's talk about it. Right. See this? Notice we have negative gamma across the curve. And here goes around 525 here. Uh, uh, that seems to be your biggest 525 seems to be your biggest net gamma exposure, right? At negative 392 million. Now, I want to point out that, this gamma exposure is not, it's not high by historical standards, meaning it's very clear that people spread out their risks, right? So very clear they spread their risk out here. So you want to really keep that in mind, right? Having that risk spread out suggests that people were just like, hey, look, let's just set ourselves up for success, either direction, and let's wash our hands and be done with it, right? Right here in the middle is where we see the least exposure. So there, it seems like we're more prepared for downside with our highest negative exposure being up here. All right. This is at this very moment, this is most certainly not a buy the dip environment, but in my opinion, it should not stop us from picking up on where we perceive to see value. And I'm gonna show you guys something right now, right? And today I'm gonna be showing you guys a strategy, and some of you guys have already seen this strategy before, but today I'm gonna be showing you guys a strategy for I'm gonna be showing you guys a strategy for determining the value that you want to purchase something at. Right? We've talked about it before, but I'm gonna keep talking to you guys about it until I'm gonna keep talking to you guys about it until I feel like it's a lock in, and I get that vibe from when I talk to you guys on Clubhouse for the most part, right? So when I talk to you guys on Clubhouse, I can tell how you guys are doing, and we get more feedback from there, right? Now, so let us proceed. Let us keep going. Okay. Um. Hmm. All right. All right. All right. Okay. So next next element here. Give me a second. Let me 1 second here. Let's go over here. Okay. So expected move through the by Monday basically, right? Um would you look at that? Look at that. Look at that low price, y'all. Look at that low price. Look at it, right? It's right around where's our come on now, right? It's right around this area right here, right? So that's the potential low that we're looking at going where we at? I'm sorry. There we go. What? Lord? There we go. So I'm sorry, no, not Monday, Tuesday I meant to say, right? Um yeah, by Tuesday. Had to double check that, right? So by Tuesday, our expected move sits at around 480, around the 486 level there. All right, right around the 486 level. Let's go to Friday. I'm sorry, no. They don't have Friday. They only have Tuesday. They have Monday and Tuesday there. So by Monday, right, 490 to 519. By Tuesday, you got like 486 to 524, which that those levels also sort of sit around so this is pretty close to this level here. So I think we said 519, right, at the high end. So it's very well that we could see the market dip lower towards maybe like 490-ish to 486-ish early in the week. and then rebound towards the 520s area to close things out. Who knows, right? We'll see. All right. Why do I keep going back there? I have. Oh yeah. There's something I want to show you guys on that. That's why I keep going back there. All right. You can see that this isn't broadening out very much. Going into May. Let's stick with April. By April's OPEX, we're expecting 475 to 535. Right, 475 to 535 by April 17th. All right. So so that's that, right? So by April's OpEx, that's how we're looking, So 475 to 535. Now, that's what we're looking like as of today, right? But remember, next week kicks off the earnings season, so there's there's a lot that could there's a lot that could change there. All right, so we'll keep that in mind. All right. But I like the numbers that we're seeing. I like the numbers that we're seeing to to going towards next week, right? Now. What else did I see? Last thing before we get into we're gonna get into analyzing some stocks, right? See if there's any see if there's any bargains out there. But the last thing that I noticed last week is we had 31 downgrades versus 14 upgrades. All right. Something I like to keep track of. I don't keep track of it constantly, but I like to keep track of it during these types of times, right? So 31 over 14, that's a 2.2 to 1, right? So we're we're downgrading stocks at twice the rate as we are upgrading them at this point in time. All I want to do is I just want to caution you guys to, do exactly what you see me doing right now, which is go over your portfolio, analyze these stocks, find out if what you're holding is something you should continue to hold, or is it an opportunity to buy more? Just dig in, right? Don't pass up on this moment in time and think, oh, this has to be the end. It could get uglier. Just for the record, it could get uglier. So the one thing you don't want to do, we're not going to panic and sell everything we have, right? But you know, make sure your money is in the strongest names, so that way okay, these are the ones that are going to bounce back for sure. The other ones, hey, whether they bounce back or not, I don't want to be in there. Is what it is. Now, I want you guys to remember that back in January and February, I already had you guys taking profits off the top, right? So, back here when we were still higher, I already had you guys, hey, you know what? Hey, if you got some profits, take them, put them back in your portfolio, hold on to the cash, wait for the opportunities, right? So, down here, the decisions you're making, if you let's say you did want to get rid of something eventually, it shouldn't be that big of a deal. It shouldn't be that big of a deal because you've already taken the profit that you've made, off the top of whatever was there. So I would only get rid of the weakest things that I have in some of these moments, but it's just time to analyze. It's time to analyze again. That's all it is. Right? Just time to analyze again. Now, um, so two things that I want to show you guys today, right? Two things. One of those things is look. So you see the difference. See, right here we have it in red. Right here is in green. Right, these last prices. When they're highlighted in green, that means they're trading below the. That means they're trading below the average analyst, below our fair value target here. Okay, so that's what that means. So that means they're trading below fair value. I want you guys to look at how many stocks are now trading below fair value. A few weeks ago, this entire list was red. I repeat, a few weeks ago, this entire list was red. Okay? Let that soak in. Let soak in. This whole list was red. Like nothing was trading. I had a few things trading, you know, below fair value, but almost everything was red. Now look at it. Look at how many opportunities that there potentially are here. That's how you look at this moment. You don't look at this moment as, oh my God, the stock market, it's bleeding and yada, yada, yada. No, 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 no. Look at how many opportunities are here now. Look at it. Look at it. Okay? That's what you pay attention to. Now, um, we're gonna get to doing some evaluations. Let's get busy. All right. It's time to see what's what. You may also notice over here, I've actually made some changes, right? From the single digit number here to the double digit number. We'll talk a little bit about that in a few seconds, right? So before we get too deep into this, I want to show you guys something. How do I calculate fair value? You'll see it says, right, H3, which is our average analyst target, divided by 1.18. So that formula looks like this. The formula looks like this, right? The average analyst target divided by, right? I'm sorry, and it's 1 plus your expected return percentage, right? So that's how you do that calculation. So if my expected return was let's say 15%, right, it'd be the average analyst target divided by 1 plus 15%. That 15% pans out to be more like a 0.15. All right. Okay. So basically, whatever the average analyst target is, it could be, you know, $400. You divide it by 1 plus 0.15 or 1 plus 15%. And I think it makes a lot more sense, or it helps people understand it more if I use the percentage, right? 'Cause if you say 1 plus 15%, you're going to end up with if you say 1 plus 15%, you're going to end up with 1.15. Okay, so I actually added a 3% premium to that, so that's 18%. So this is how I'm able to calculate the fair value. Just want you guys to know that, so that way you can do that for yourself when you need to, right? Because what do I always tell you guys? If it's one thing you can do for yourself, it is discount everything. That's the one thing you can do for yourself. If you don't know how to research the stock yet, if you don't know how to find the right picks, if you don't know how to dig into the market and find all the details and the gray areas that matter, if you don't know how to do all that just yet, If it's one thing you can do that anybody can do is discount a stock's valuation. It's literally as simple as I just told you. Okay? The stocks, right? So whatever they say the stock is worth, right? Watch this. I'm gonna go over here to stockanalysis.com. Here goes Pepsi. Here goes Pepsi right here. Okay. Um, let's go to the forecast here. The average analyst is saying Pepsi's worth $170.14. I say, okay, let me get a calculator, right? The average analyst is saying that where was I at? Right here, $170.14. I say, okay, 170 14 cents divided by 1.18. Okay, so all I right then and there, I just discounted Pepsi's valuation. So they're telling me it's worth 170. You guys got to remember something. That does not mean you should buy it for $170. That means that's what it's worth. If it's worth 170 and I buy it for 170, what's my profit? I'll wait. I want to see some answers in the chat. If I buy it for 100, if it's worth 170 and I buy it for 170, what's my profit? Zero. Zero. Right? What's my probability of making a profit? Very low. At least if we're talking over the next 12 months, right? But if I buy it for 144 bucks, if it's worth 70, and I buy it for if it's worth 170 and I buy it for 144 bucks, right? My probability of making a profit just became so much greater. My probability of profit just went through the roof. And that's what I want you guys thinking about. I want you guys thinking about probability of profit, right? Probability of profit. That's what I want you guys thinking about. All right. Now, you could have a decent dividend and still end up not getting a profit. Why? Because if you buy it at the wrong price, the price decline is more likely to be greater than the dividend. All right. Well, for example, all right, let's use this as an example. We'll use Pepsi as an example because Pepsi pays a dividend, right? So Pepsi pays a dividend. Uh, let's see here. Where's it at? 3.7%. They pay a dividend of 3.7%, right? But the stock is down 13.6% over the past year. So therefore, right, you're still down. But look at where Pepsi is. Isn't it crazy that Pepsi is literally, Pepsi is almost at our target that we just discussed. Literally, Pepsi is almost at the 144 right now. So all I had to do was when Pepsi was up here, discount it, discount it, and then it would have said, "Oh yeah, let's not buy Pepsi until we hit this level." Plain and simple, right? Now, I'm the type of guy I like to build tools and stuff like that. I'm gonna show you guys today how to build a spreadsheet to discount with. Y'all ready for this? All right. How to build a spreadsheet to discount with. I'm gonna teach y'all this right now. Pay attention. I'm on Google Sheets. The best way to get to Google Sheets is so you go to you'd end up on like docs.google.com most of the time. If you end up on docs.google.com, you click this little menu right here, right? I hear most streamers calling this the hamburger. You click on the hamburger, right? And you go to Sheets, okay? From there, um, you're gonna go to. Let me see if they have any templates here that you can use. Let's see. Any good templates? Any good templates? Any good templates? Mm, eh, I'm gonna go with blank. Let's go with blank template. Okay. Let's go with blank template. Okay. What I'm gonna do next. What I like to do is I like to if I hold the shift key down and I press the right key, 1, 2. All right. I'm gonna highlight two more boxes. So it's gonna right. Hold the shift key, press down once, then boom, I get those things highlighted. Right here, I hit the merge cell. Merge the cell, and then I'm gonna say discount model. I'm gonna say discount model. All right. Let's go ahead and drop this right in the middle here, and let's center it. Okay. Hope y'all paying attention. Hope y'all are paying attention. All right. Now, I'm teaching you guys how to build a very simple one. This is gonna be a very very simple one. Okay. So we're gonna say right here is gonna be the price target. Okay. Right here is gonna be the discount, and right here is going to be. Matter of fact, I got you guys. I got y'all. Here's what I'm gonna do for y'all. Here's what I'm gonna do for y'all. I'm gonna teach y'all how to build a beta adjusted discount model. You heard me? I'm gonna teach y'all how to build a beta adjusted discount model right now. Put your beta right here. Right, put your beta right there. And then right here should be your what you call your fair value. Okay? So we're gonna put our price target right here. Our discount is gonna be let's see here. We'll put our discount at 15%. Okay. Our our discount's at 15%. Our beta is there. And we're gonna call this our time value multiple or TVM. Call this our time value multiple. All right. Okay. First I'm gonna test this out. First, let's test this out. Let's say our beta is 1.05. Well, let's say a 1.1. Okay. So we're gonna say equals 1 plus. Put this in a parenthesis, right? 1 plus this times this. Okay. And voila. And voila, right? So this is what you're going to get here. Now, the next thing I'm going to do is I'm going to say equals this divided by, right? So slash this. Right now it says zero. Right now it says zero because we don't have a price target, right? So so um so we're gonna go and we're gonna use we're gonna use one of the stocks that AC put in the chat earlier. We're gonna use Caterpillar. We're gonna use Caterpillar. Now here's what's about to happen. All right, we're gonna go. We're gonna go to Caterpillar. They're trading at $288 per share right now. All right, over the past 5 years, they're up 151%. Okay, for the past year, they're down 23%. Their price target is $383.80. Their beta is a 1.2. Okay, 383.80 and 1.2. Let's go back. Where we at? So 383.80. Their beta, their beta is a 1.2. Okay. We're going to hit, so we're going to click on this right here. We're going to hit the money sign. Money. Click right here, hit the money sign. All right. And you're good to go. The only thing you need to do now maybe is to increase the size. You know, if you wanna, you wanna have that be bigger there, right? I might also prefer to have this be out of the corner, be more like in the center of my screen, right? Actually, I might also prefer to have it be just a little bit, more right here, But either way, so that's how you build a discount model. That is the most simplest discount model you can build. That is the simplest discount model you can build. And it's based on one of the simplest formulas that I ever learned in finance. I always told you guys about this one, EPS over R. Right? Simplest formula. Um, it's based on that formula, but it uses the time value of money to just discount. Because here's the thing, right? If you look at these targets right here, all right, all the analysts in the world that cover this stock combined to create this price target. So whether they were bullish on the stock, bearish on the stock, neutral on the stock, whether they thought the stock was going to grow earnings by 50%, 4%, whatever, all of those targets came together to create this one target right here. So we know they've done a ton of research. We know they've done a ton of research. However, I still want to know if I want to buy this stock. So I know that $325 and 25 cents is the best price for me. They're currently trading at $288. By the way, look at how it stopped right around the 325 area. Y'all see that? Look at that pause around that 325 area. I'm just saying. You know that happened. Look, 325. Look at how so many times it stopped around the 325 in the past year. This is the past year, right? Showing that 325 is most certainly a strong level for this stock. For the TVM, right? This is our time value multiple. Our time value multiple, right? We have 1 plus 1 plus in parentheses E7 or your discount times the beta. 1 plus the discount times the beta. All right. 1 plus the discount times the beta. All right. Um, and all I have to do is come in here. Let's take the other stock that he put in there, IFRA. IFRA. Let's do that. Oh no. This one is a this one is a an ETF, right? Um, but we do have a beta. If we did have a price target for the infrastructure ETF, then that'd be a difference, right? Um, but let's take a look at let's see here. Let's go to McDonald's real quick, right? We're gonna go to McDonald's, right? So I'm going to them because I know they have a low beta, right? So they have a price target of 323, 79, right? Beta 0.62. 323.79.62. I get 296.24. Now, if McDonald's was as volatile as Caterpillar, I'd want to pay 274. That's what they're telling me. Y'all see what I'm getting at now? If McDonald's was as volatile as Caterpillar, a 1.2 beta, I want to pay 274. But McDonald's being much less volatile, I want to pay 296. Okay? What's McDonald's trading at right now? $301. We're getting close. Where were they? What was the high of the past year? Right? They're up 8.9% in the past year. So this is one of those other situations where the stock is rising in the past year, but you still don't want to overpay. Right? So you might want to make sure you discount it anyway. Right? So nonetheless, it's telling us let's pump our brakes here. Let's pump our brakes here. Right? Let's discount based on beta. Okay. So this is a beta adjusted discount model. We're going to use this today. We're going to use this today to pick up on some targets here. All right. Okay. Let's talk about it. And by the way, so I want to see the market below this level, right? And if I can get it, I'd like to see the market below this level and oversold and below 30 on the RSI. I would love to see both of those, right? By the way, if you want to, you know, um, feel free to make these things larger if you want to. You know what I mean? If that, you know, I like to see big letters. I don't know about y'all. Like I like to see things a little larger than this. So so styling it is up to you. Getting it styled out is up to you. You know, just gonna style it out a little bit here. It's like to see things bigger is all I'm saying. You know, that works better for you. 'Cause a lot of times it works better for me. You know. It's up to you if you want to, just kind of like I say, if you want to stylize it, just kind of make it bigger, whatever you want to do. All those things are up to you. All up to you. All right, y'all ready? Let's get this party rolling. So what if we put the price around 50 on our side? Do we buy? So what if we're at a price now? On the side of Bobby Carson or wait, no, and only using 50 as an example. No, yeah. I get it. So what I would say in that regard, right? What I would say in that regard is, you know, are you above or below 50, right? Um, and is the market rising out of out of a is the market rising out of a downturn, or is it currently in a downturn, right? So if that stock is currently on the way down, then I would usually say, okay, cool, I'm gonna go ahead and give it another day. I'll wait. But if that stock is rising out of something, then you being at 50 on the RSI. I mean, that may only get worse after that day, right? All right, let's go. EA. By the way, I'm gonna add McDonald's to my list to look at. Hey, Cecily, where you at? You out there? Once knew a guy that went short McDonald's and long SBEV. Yeah, definitely, Alvin. That was a great question. That's a great question, man. Uh, yeah, I once knew a guy that short at McDonald's to go long SBEV. It was not a good look. Um, oh, that's right. I think Cecily said she worked Saturday to have off on Monday. I think she said. Ouch. All right, so let's go with what's up, Prince? What it do, man? All right, let's go. We're gonna go EA Sports first. Let's go EA. All right. And just for the record, I am analyzing off of this list right here. All right, I am analyzing off of this list. I'm gonna show y'all a little something that I started doing recently that I'm actually feeling. I usually have my risk analysis outside of my investment grade. Recently, I started taking the risk analysis and allowing that to subtract from my investment grade. Right, so it's more of a it more so takes away from the grade the higher the risk. Let's get to it. I'll show you guys what I'm talking about. Okay, so with EA, fantastic Altman Z, fantastic Altman Z. F score of a 6. We're looking for a 7 or better. All right. Earnings per share, $3.92. $3.92. Yeah, Aldrin. Yeah, bro. It's actually really great to do it this way. You'll see. I'm gonna show you in a second, man. I'm gonna show you in a second. All right. So we have $3.92 in earnings, $7.26 in free cash flow per share. So that's a really great look. That's a really great look right there, right? Shows the earnings are very strong and backed by free cash flow. All right, quick ratio of 1.26. Excellent. Debt to free cash flow of 1.2. Excellent yet again. Return on capital employed 14.9. Excellent. So we're scoring a 5 out of 6 on this first part of the grade here. All right, let me get rid of this and let's pull up our discount model. All right, let's go to EA. Now see this one right here is not beta adjusted, right? It goes straight for the 18% discount. Um I'm gonna beta adjust it right now so that way we can just use this. Okay? So you guys will know that this will be the same thing here. So one, hold on, wait, hold on. Actually I need to do this real quick. Uh, One plus uh, I got all kinds of little formulas hidden all around my sheet. So it was 120, 124. Now it's 132-ish. All right. Then what I do is I just hide this. Right. I just say bye bye. Right. Later on I can say, okay, what is this? C31. I know it's C31 right here, and I can come back and check it out. All right. Okay. Earnings acceleration. That's the next thing we're looking for. The next thing we're looking for is earnings acceleration. All right. So we're gonna say last year or last 12 months, earnings grew by 4.95%. This year, they're projected to grow by 14.6%. That's clearly an acceleration. All right. Compound annual growth rate is solid. And our 25/40 rule, which says that companies in tech, we want to we want to have a rule around 30 to 40 or better. Companies outside of tech will take 25 or better. All right. Now, our this is built based on the sales and the operating margins. Right. Trailing 12 months earnings is negative. Right. So we're projected to accelerate into this year. Right. So um we're projected to have a pretty decent turnaround for EA Sports. Well, for EA, let me not for Electronic Arts, I should say, not EA Sports. All right. Um, Based on our two targets here, we got about 130. We can say 132ish. We're going to use this target mainly today. All right, we use this target mainly today. Um, so all in all, they score an 8. So that's an 8 out of 9. So that means their score right now is 88. The score right now is 88. What I'm going to do is I'm going to look at the risks, and every time a risk pops up, I'm going to subtract from the score. If the free cash flow yield is below 4%, that'll be -1. It's not. Okay. If the Altman Z score is below 2.5, it would be -2, but it's not. If our return on invested capital were below 5%, we would have -2, but it's not. All right. Now, if our projected growth rate, where's it at here? If our projected growth rate was below 6.5%, we would go -1, but it's not. And then last but not least, our revenue growth from a quarterly perspective, we want to see it rising for 3 straight quarters. Rising for 3 straight quarters. And we don't have that here. All right. So that would be, so basically from here I meant to say it would be rising, 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 right? And we don't have that. So they are going to get a -1 here, but that still puts their grade, right, at an 87. So you guys get the point. All right. So they could have had a total of 7 points knocked off of their grade. And so that's what we're going to be doing here today. All right. So we're going to be analyzing these stocks, grading these stocks, and then analyzing them based on the risk that we actually see there, right? So, but I'm gonna be going through these pretty quickly. So stick with me. All right, Caterpillar, let's go. We're gonna go back to the request I was put in the chat earlier. Caterpillar. All right, let's go. Let's go. Let's go. Let's go. Hmm. Okay. All right, that's two. We want them to do better here. Okay. Okay. Earnings $22. Free cash flow per share 18. Solid earning strength. Right, 24% return on capital. Right, so they're giving us a 5. Let's go Caterpillar here. Earnings are accelerating, right, from a negative in the previous period to a plus 12% in this current period. But our growth rate is not what we're looking for. Our 25/40, we can deal with 25.9% in terms of this operating measure here. So now in this particular case, Caterpillar is scoring a 7. They're scoring a 7 out of 9, so that's 77%. We can already say -1 right here, so that's 76. All right, we can already say -1 right here, because we know that we're looking for 6.5% right here. All right. Now let's go over to stock analysis again. We already know that they didn't fail any of the other areas. All right. But we got to check the revenue. And from a quarterly perspective, you can see right here, see this period right here? One, two, see that period right there? That's what we're looking for right there. We're looking for this period right here. All right, actually right here, I should say. Boom, boom, boom. Continue into this period, drop off a little bit. All right. Okay. We're looking for those 3 consecutive quarters of revenue growth. That's what we're looking for. All right. So Caterpillar scored a 77 initially, but we have some risks there with their earnings growth being on the low end and revenue their revenue growth being a little stagnant as well. Right. So we're gonna assign Caterpillar a score of a 70. Right? We're gonna give them a score of a 75. All right. Let's see what Caterpillars look like over the past year. They're down 23%. Past 5 years, up 151%. So not bad. And by the way, 75 is actually pretty good. Anything 70 and up is, in my opinion, still an investment grade company. Once you fall below 7, you start to get speculative. Once you fall below 70, you start to get speculative, right? Um, and you know, anything below 50, I consider to be, you're taking a greater risk, right? So you got to ask yourself, why are you taking that greater risk? You got to really go through those things with yourself. All right. Now, according to our grade, remember, 323.51 is the price that we would look for Caterpillar. All right, 323.51. This is based off of our discount model that we built earlier. Okay. And later on, I'm gonna pop open a clubhouse room if y'all want to ask questions about the discount model. Okay, so that way y'all can get those questions off verbally. All right, now let's see here. So that was Caterpillar scoring a 75. Next on my list was Costco. Next on my list was Costco. Give me a second while I just grab something to drink. 1 second. What's going on, Romeo? Thanks for dropping through. Make sure that you hit that little green heart that you see on the screen right there, and hit that follow button. We're working on getting to we're working on getting to our 50 followers. Make sure you pop in. Make sure you hit that follow button. How I got to 75. So when they score a 7 out of 9, that means they automatically have a score of 77. Right? That's a 77. All right. Now, in scoring 77, we then start to subtract the risk that we see. Right? We start to subtract the risk that we see. Shout out to the Romeo for the follow. That's the little thing you guys see on the screen, the little hearts at the top. Shout out to Romeo for the follow. So yeah, so you start subtracting the risk that you see there, Christopher. You start subtracting the risk. So they had a -2 on risk, basically. So they originally scored a 77, and then we subtracted the risk. So those so let me point out the points for risk so that you know what they are. Okay. So the statistics. So the first point for risk is the Altman Z. If that's below 2.5, that's -2 points. If that's below 2.5, that's -2 points. Okay. And I would say if it's below 1.8, it's -3. All right. Then you have your return on invested capital. If that's below 5%, it's -2 points. All right. Next, you have the compound annual growth rate. Right. You can find it here sometimes. Right. Your EPS growth forecast. If this is below 6.5%, we're gonna say -1 point. Right. And then your revenue growth, if we don't have 3 consecutive quarters of revenue growth, that's -1 point. Right? So revenue growth -1 point. Um, earnings growth forecast -1 point if it's below 6.5%. All right, -2 points here if this is below if this is below 2.5. -3 points if it's below 1.8. Right here, your return on invested capital. If this is below 5%, -2 points. If it's negative, run for your life. Right here. Oh, I'm sorry. I'm sorry. So no, they actually got minus. They actually got 74, not 75, by the way. Because your free cash flow yield, if this is below 4%, -1 point. Okay. If this is below 4%, -1 point. All right, Christopher, you got that? So let's go through with Costco real quick. Go through with Costco. So excellent here and here, right? Excellent. All right. We'll be going over it again. So just just kind of keep your eyes on things right here. So Altman Z 9.2, F score 8, excellent, right? 1 point each. Now we're doing the investment grade portion. So these are your positives, right? However, your quick ratio is not looking good at all. We don't like that. All right. Your debt to free cash flow is a 1.16. Excellent. So far, 3 out of 4. All right. And your return on capital employed, 26.9%. We like that. All right. So that's a 4 out of 5. Then you match your free cash flow with your earnings. So you want to see, well, am I getting a lot of free cash flow from my earnings? And as you can see, they're doing just fine. You want this to be at least 65% of earnings. So what you would do, let's go back to let's do a calculator again. Okay. Do a calculator again. So what you would do here is you would take your earnings per share, right, and your free cash flow. So you go free cash flow, $15.61, right, divided by earnings per share of $17.13. Hold on. The six must have not went through. Let me just clear that. Oh, yeah. Now let's clear this out. Clear, 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 clear. So $15.61 divided by, dear Lord, divided by. I moved the whole thing over to another screen just now on accident. Divided by earnings of $17.13. All right. You get 91. You get 0.91, or that's 91%. Okay. You can just multiply it by 100 if that makes it better for you. Right. And you get 91.13%. All right. So as long as this number is greater than 0.65 or 65%, you're good. That means you have quality earnings, right? Because earnings are more related to operating cash flow, right? I repeat, earnings are more related to operating cash flow, meaning our our earnings. Um, when we go to our cash flow statement, we usually have our operating cash flow is our earnings, and then we add back like the depreciation, the amortization. We add back those things to get operating cash flow, right? And then we take away all the capital expenditures. So it's like saying, um, it, basically your free cash flow to earnings is like saying how well can you handle your capital expenditures, right? And I don't want you spending all of I don't want you spending all of the money on capex, right? So a company that still has more than 65% of their earnings left for free cash flow says to me that, they're definitely, well in the advantage territory. You know what I'm saying? So either way, so we had let's see here. We had what was that, one, two, I think that was 5 out of 6, right? So three, four, and 5 out of 6. Let's see. Let's come over here now. Okay. Costco. Alrighty. Come over here because so basically there we might have requested too much third party, so we're gonna have to go directly to FinViz now. All right. So what this spreadsheet does is it requests information from FinViz and does the math for us. Basically, that's all it does. So we can always do without it, and this is why I always try to teach you guys how to work without this stuff. Right? You shouldn't always have to have it. So, um, Here we are. So earnings this year, right? Earnings growth this year, earnings growth next year. Right, as you can see, 8.98 versus 10.6. So excellent, right? Excellent. This shows us that give me 1 second, guys. All right. So we got our earnings acceleration, and then from there we look at our sales, right? Past 5 years. So I like to use the average sales. So it's kind of like how they do like the cyclical PE, right? Your Schiller PE ratio. I do the same thing. I smooth out the sales growth. I smooth out the sales growth by using the average sales growth. So that's 10.86 plus our operating margin gives us about 3.69. Now, I'm gonna be honest with you guys. Because we're dealing with a grocery store. This is why I do like to do some of the calculations myself sometimes. We actually usually use the gross margin for a grocery outlet, which says that they're doing just fine. The reason why is the profit margins for a grocery outlet is always low. Profit margins for a grocery outlet is always low. You're not gonna get a grocery outlet that's got robust profit margins. Okay, so I would actually use the gross margins here in this particular case. Um, and I'm probably gonna put together like a 40 gross and a 40 and a 40 op one of these days, just to you know just to make sure that I have both of them. Uh, you know, uh, just having both of them around, in the future would be pretty dope. All right, so I think they're doing just fine in that area right there as well. And then the next 5 years earnings growth is about 10%. So all that looks good to me. So Costco's, I think they missed 1 point there, so that puts them at an 88. Puts them at an 88. Right, we can close this for now. We won't need it anymore today. Puts them at an 88. Right. Now let's see. Is there anything that we need to subtract? Right. What's the free cash flow yield looking like? Free cash flow yield is a 1.7, so we're going to subtract 1 point. Okay. Um, Free cash flow yield is a 1.7, so we're going to subtract 1 point because it's too low. We're looking for 4% or better. Right. Revenue growth, as you can see, we want consecutive quarters of revenue growth. And now you can see that they're more of a cyclical. So if somebody wanted to give them this and say, okay, but every year their revenue grows, you can do that as well. You can do trailing. You can say at least 3 trailing periods. I like to do that as well. So whenever I see these earnings that are very cyclical, we can do trailing signals, as well, right? But they still don't have it because I think no, actually they do. They got it, right? So we're gonna give them an 87. We're gonna give Costco an 87. All right. Where's they at? Where they at? Where they at? Where they at? Where's Costco on this? What did I do? Did I do something? Oh, they're right here. 87. All right. And that's pretty much how we're looking at it. All right. So I appreciate everybody for sliding through. We're gonna I'm gonna actually switch over to Clubhouse so people can ask questions and stuff like that. So again, don't forget, I showed you guys how to build that discount model. I want to know when some of you guys, get to building up some of the models and let me know how that looks. Okay. Um, so I'm gonna switch over to Clubhouse so we can actually talk live and see if anybody wants to, you know, see if anybody wants to maybe ask some questions and things of that nature. All right. Appreciate it, Kenny. We're gonna so every Saturday I'm gonna try to teach something every Saturday that we can learn. Don't forget our key levels for next week. All right, our key levels for next week. Let's go ahead and slide these fibs off of there. All right. So that 484, 521, 559. Those are our key levels going into next week. Those would be the strongest points of support and resistance there. All right. Uh, I'll catch up with you guys later. Everybody be blessed. Stay well. And I'll see you on Clubhouse later.